Welcome everyone to the Passive Investing Made Simple Masterclass. Today we're going to talk about how to use debt to replace your income. So maybe you're sitting here, you've invested in a few passive investing deals, and you're trying to figure out how to scale, and you're just like, I don't know what the best path is for me to ensure that I have an income in the next 7 to 10 years to where I can retire. If that's you, you're in the right place because we're actually going to talk about and visualize how to build this plan. What are some of the tools that you can tap into today's market that are predictable, stable, and can provide that nice kind of smooth glide path into retirement. Okay, especially if you're targeting it in the next, say, 5, 7, 10 years. Now, we do this masterclass live every Tuesday to help you learn how to take your active income and turn it into passive income and long-term wealth. So maybe you've actually tried investing passively before, but couldn't get comfortable making an investment, or you actually invested in a deal before and just realized, whoops, I don't really know if I actually invested in the right deal that fits my portfolio. Or maybe you are a seasoned passive investor and you're looking to either build your skills or pivot your portfolio. If that is you, you're in the right place. Now, again, my name is Whitney Elkins-Hutten. This is, if you're watching the video, you're seeing a picture of my family. I call them my crazy crew. This is the whole reason why I love investing in real estate. Well, more importantly, continue to take my active income that I make from my investments and turn it into or invest in passive deals in order to continue to scale and pump that engine to kick out more passive income for me. Now, I've taken my day job income and turned it into passive income, but I've also taken active income from other real estate investments, residential investments, express car wash investments, self-storage investments, even flipping that I've done. And I've pumped it into building a passive income machine for myself and my family. Now, I teach people how to do this through this masterclass here at passiveinvesting.com, and my role as Director of Investor Education. I also coach people one-on-one. And I also wrote my book, Money for Tomorrow, to show you how to, especially if you're just starting off your financial freedom journey, what are those basic skills that you must master? Okay, it's not which investment tactic, but what are those skills that you have to master in order to build real wealth? But all of this is in service of one goal, which is how do you get 100% control and choice on how you spend your time, right? Financial freedom is just a stop along the journey to getting the other 5 freedoms in life: choice, time, location, freedom to create an impact. And so that is what I love teaching people how to do, and showing people what investments they can make with us at passiveinvesting.com to help them achieve those goals, be it in our equity investments or in our real estate debt investments. Now, today we're going to talk about how to turn that active income and invest it into debt funds to generate reliable income. And we also are going to compare it and contrast it to equity deals as well. But before we do that, this is your invitation. Join us in the Passive Investing Club. If you like what you hear today, you want to talk more, understand your goals, your risk, your timeline, how we can help you meet those, make sure to fill out the form at passiveinvestingwithwhitney.com. You can scan the little QR code there. We can show you deals. We can even just talk about your goals and help you realize that through passive investments. Now, we are going to be talking about math today. And as always, any webinar, really, be it this one or anything that you watch on YouTube, especially Instagram and TikToks, it is not financial advice, legal advice, or tax advice. You have to take this back to your investing team before you make any sort of investing decision. All right, so if you're watching this presentation, you're like, okay, we're opening today's presentation talking about employee versus full-time investor psychology. Okay, Whitney, I thought we were going to talk about how do I invest in debt in order to, break those financial handcuffs. That is the first step. We have to understand our psychology because it is very different. If we are going to build a passive investing portfolio, be it in equity or debt funds, we have to master a different way of thinking, meaning we are now taking back control from Wall Street, from the stocks, bonds, and mutual funds we've been investing in. Now, maybe you're not making 100% pivot. Okay, maybe you're just pivoting part of your portfolio. But even then, we have to get out of employee psychology and move into investor psychology. What do I mean by that? Is that instead of somebody else, a fiduciary, telling us what our goals, our risk, and our timeline for investing is, we need to decide this for ourselves. Okay, that is the first shift in building a portfolio that is going to break those golden handcuffs for yourself. So let's ask ourselves a few questions, and we're going to dive into these questions. But first, we got to understand, what do you want? Why do you want it? Okay, and who do you have to become to get it? Now, the first half of all of this is we have to establish some habits. And if you are a follower of the One Thing book by Jay Papasan and Gary Keller, this quote is quoted so often throughout any of their presentations, even in the book. People don't decide their futures, they decide their habits, and those habits decide their futures. It's by F.M. Alexander. So let's dive in. What are some of those habits that we need to master in order to build this passive income, especially using debt funds, right? That's going to be the tactic. Let's back it up to the strategy. All right. So first, mindset. Okay. We have to, even if I show you how to break down all the math and I just say, okay, great, the investing in debt funds is the best thing since sliced bread. I can show you in 10 years how to acquire a portfolio of $2.3 million that kicks off $230,000 a year of annual income. I can show you how to do that. But if you haven't mastered your mindset, you'll never be able to take advantage of that portfolio. Meaning, if you haven't unhooked your identity from your day job, you'll never retire, okay? Or you'll never pivot into something that gives you more, taps into more of your passion or allows you to create more impact in the world, okay? So this is something that I talk often about on my guest podcasting that I do is how do we, along the way from turning from employee to full-time investor mindset, how do we kind of start unhooking our perceived identity into that of being that as an investor. Now I'll pick on myself. For me, for the longest time, I could not foresee ever retiring from public health. Why? Because I went to school for public health. I was in the medical profession. That is what I did. My identity was there. Somebody said, "Hey, who are you?" I said, "Hey, I'm an epidemiologist. This is what I do. This is my passion." However, when I eventually was, at one point in time in my career path, I was let go from a job. I was laid off during a company merger. And that was like very startling for me. Okay, so I actually had to begin how to unhook my identity from how I earned income in the world. And that is a great first step, especially when we're going to build this portfolio. Because when I work with investors, there's resistance. If they never start unhooking their identity from how they earn income in the world, they don't do the necessary steps in order to actually scale that portfolio that will give them financial freedom. Okay. The other part of that mindset is we have to learn how to start taking calculated risk and fear set those. Okay. Understanding what is the worst that could possibly happen. And let's prepare for the worst, but we're going to invest, for, the optimal outcome, right? Then also, how do we think into, cathedral-like thinking? This is something that a good friend of mine, Gino Barbaro, showed me several years ago, is we need to learn how to fall in love with the journey of investing, not so much be attached to the exact goal, right? So that allows us to stay in the here and now. Okay, what's happening in the markets today? How can I invest what I see around me today? What are the opportunities today? As opposed to like, I have to achieve this goal. What is right here in front of me? All right, so the other part of who do you have to become is, learning the actual skills of investing. Okay, so we have to learn how to track our income and expenses, for our personal wealth, our business wealth, our portfolio wealth. Okay. It's not just something that we do once. Okay. This is one of those basic skills that you have to master and you have to execute all the time in order to build real wealth. Okay. Then we have to create an investment thesis and a plan and stick to it. And I'm going to show you that plan, when we create that plan here today and we actually stick to it and we allow it to work for ourselves, it can be pretty automatic. We can actually say with some reliability, yeah, I can actually see the path to retiring in 7 to 10 years. Okay. Then we have to build the network, right? So mindset, skills, and network. Now the network, it could be building valuable operator relationships, valuable investor relationships, or just creating connections, that allow us to tap into other opportunities. All right. Now, as an investor, this means we're constantly like vetting operators, vetting their deals, understanding, what is going to actually fit our portfolio, that investor thesis that we have set for ourselves. All right. The other part of, kind of pivoting from the employee mindset into wealth building, okay, especially if we're going to build this portfolio using debt funds to help us retire in 7 to 10 years, is we have to understand how 4 basic principles of investing work. Okay. Now, I always talk about 7 principles of building wealth, 7 pillars of wealth. Okay, there are 4 that really, when we are building a portfolio for retirement based off of debt funds, it's really tapping into these 4, the big major players. 1, preserving capital. Okay, we're putting ourselves in a position to where we're protecting our capital. Okay, we're not taking high risk with that capital. We're actually taking pretty low risk with the capital when we invest in debt funds. Because if we can stay in the game and allow the growth on that capital to continue to compound, okay, we're going to build faster. The other thing about investing in debt funds, it taps into that pillar of wealth, cash flow. Now, here's the thing. We can keep that cash flow now, okay, and consume it, use it for everyday expenses, or if we can actually reinvest it back into our portfolio, we can actually get equity-like growth through compounding and tap into principle number 3. So we can actually use the cash flow we get today, compound it back into the portfolio to mimic equity-like growth. All right. And so we can actually get, 3 of the basic 4 principles utilizing debt fund investments. Now, number 4, investing in debt funds, okay, you can be a strategic diversification play. Because I know me, maybe this is you too. There was a time in the market cycle and I was heavily invested in equity assets. This is an amazing time to add in those debt plays, those debt layers into your portfolio to help you create that strategic diversification. Right? At some point in time, we might take that cash flow that we're getting from our debt funds and start putting it into equity investments, right? We can kind of pivot back and forth between building out these 2 tiers, but we can't ignore having that predictable cash flow layer because that actually helps us with liquidity, cash flow, and when we compound it, it actually allows us to grow our portfolio in a pretty low risk way. All right, so we talked about what do you want? Why do you want it? Who do you have to become to get it? Now let's talk about another kind of piece on this journey of building, a portfolio that's going to allow us to unhook those golden handcuffs. And that is, we have to know our financial goals. Now, this applies whether we're investing in debt funds or equity funds. We have to know our financial goals. Okay, so I want you to think in what mile of your financial journey are you trying to hit right now? And what milestone will you be trying to hit here in, say, 5 or 10 years? Okay, so the financial milestones are security. What cash flow do you need coming in today to pay for the roof over your head, the lights coming on, the heat staying on, and food on the table? Very basic needs. And then we can think about the next milestone, which is financial vitality. What is going to allow us to have, some play in life? Maybe we go out to eat a little bit, buy some clothes, have like a little bit more freedom in life. Then we get to independence. That's the 3rd milestone. And this is where a lot of people try to go from earning their income completely in their day job to financial independence. And it's such a huge disconnect between point A and point B. We got to insert those other two milestones along the way. So what? We can actually pat ourselves on the back for making progress. But financial independence is where we're replacing our current income from our investments, okay? Our current lifestyle, right? Then we get into financial freedom. This is where we're actually thinking into the future. What do we want our lifestyle to look like? Do we have maybe a luxury car, a second home? We're taking more vacations. That's more the financial freedom. Now, those are the different financial milestones that are along this journey here that will help us visualize how we need to scale this debt fund portfolio in order to actually retire how we would like. But we need to take into consideration some additional questions. And, these are questions we talk about when we're thinking into how do we design our investment thesis or, our investing plan for ourselves personally. What is your timeline? How many years do you have to hit this plan? Okay. Now, we can't actually we can extend our timeline, but there's a couple different ways we can collapse time. We can either put more money into the plan, okay, or we can actually put less money into the plan and extend our timeline. Those are two different ways we can achieve the goals. Also, we can accept more risk, okay, a higher return, potentially higher reward. However, I don't encourage investors really to take on higher risk if you don't have the time to recoup from taking that risk. Okay, so we have to think about what our risk tolerance really truly is and what is our capacity for potential downturn or loss. Right? We have to think of the risk tolerance and risk capacity in tandem with each other. This is the area where most investors I see take too much risk, okay, and not fully understanding their capacity. They're crossing their fingers that if they go into the highest risk, highest reward category in all of their investments, they're all going to be a home run. There will never be, an investment that gets challenged. And, they can't take the hit if something, stalls out or unfortunately, becomes a complete loss. Now, I sit on many investment groups, and even the most prestigious organizations are not, they always have like, a certain percentage of their portfolio that have been challenged, that have not played out. Okay, the point is, when we think of risk tolerance, risk capacity, we also have to make more bets, especially if we're going to be in equity. All right, then we have to think of return on our time. This is where I really love doing passive investing, even especially debt investing. I can get a high dollar or ROT, return on my time, by investing in passive debt fund investments. So let's look how this kind of plays out. So modeling a portfolio of an investor that says maybe they have $500,000 sitting in their self-directed IRA accounts right now. Bonus points if it's on the rest side of everything. But they decide maybe they have $1 million, okay, but maybe they're going to take just 500,000 and they're going to, put that into note fund investing or debt fund investing, and then they're going to take the other 500,000 and leave it in their equity investments. Okay, so that 500,000 with our particular fund, we get them a 9% preferred return. Our annual distribution would be $45,000. But we're not going to consume that. We're not going to take that out as a distribution. We're going to invest it right back into the portfolio. And if this person is still actively working, this could be you, you can add $100,000 to your investment. This is what the model here is saying. And if we do that for 10 years, okay, at the end, actually at the end of 7 years, we would have a portfolio that was 1.6 million total invested. That kicks off 161,000 of income. Now, if we pull that out to year 10, we'd actually have 2.4 million in the portfolio. That kicks off 248,000 of annual cash flow for us. Okay, most people can do pretty well, on a 6-figure income. All right. And this is, again, um, you know, just one way of creating this portfolio. Okay. This probably is going to be an investor that's closer to retirement, has already built up a sizable nest egg. Now, we already talked about the return on time. We have to take that into account. This is one of the reasons why I really love debt fund investing is because I can get a high ROI on my, or ROT on my time. It might take me 1 hour a month to actually manage my investments into this fund, read the property updates, account for filing my taxes, everything like that. Um, and then I get to do whatever I want with the remaining part of my time, earn more income in my day job, do other types of investing. I get a very high ROT, return on my time. Now, maybe you're earlier in your investing career and you don't have a huge chunk of money to put into this. What does this path look like for you? Can you actually retire in 7 to 10 years? And the answer still is more than likely yes. And this model actually assumes $100,000 investment. Our initial return would be 8%. Okay. Again, we're going to take our annual distribution. We're going to continue to compound it, add in $100,000 a year. In 3 years, the distribution would be $36,000. In 7 years, $81,000. And at the end of 10 years, the portfolio would be $1.5 million at $152,000 in cash flow a year. Again, not too shabby. Most people can actually do between that, Social Security, any pensions or other retirement streams of income, they can do quite well on that type of income. Now, this is usually where I get an investor that pops in here and says, great, Whitney, debt funds. I see the path, I see the math, but I love equity. I want that growth. I want the depreciation. I want the tax benefits. Yes, but let's take a look at the model. All right. Now, here is a 7-year retirement plan via equity. Okay. And it assumes an investor is coming in with a very high chunk of cash, $500,000. And it assumes a 7% preferred return, that they're actually getting that cash flow and they're reinvesting it. Okay, and it assumes that the actual investment will kick off a 2x equity multiple. Now, these are have been in the past industry standards for a return. However, sometimes this gets compressed. Our preferred return isn't as high, our equity multiple isn't as high. Now, at the end of year 10, they actually will have, if all the investments play out, $2.5 million. But here's the thing. At most, the cash flow from the investments would be kicking off $180,000. Now, we've got a lot of equity growth occurring here that can continue to grow and compound. That is true. But if you are looking to retire, you actually, let's go back here to our first investment, would do better being in a debt fund investment and earning a little bit more cash flow, $248,000 a year. All right, almost a 25–30% increase in cash flow. Now, again, there's no right or wrong way here. Okay, if anything, investors should consider having both debt and equity in their portfolio. But I want people to see that there's actually a path, a clear path, even in today's environment, even with cash flow being compressed on a lot of equity investments, there's a clear path for you to use a debt fund in order to retire right now, today. All right, now we talked about the return on time metric. Now, again, this is usually where I have an investor step in and say, hey, Whitney, I actually get a higher rate of return when I manage my own investments. No, thank you. I don't need to do passive investing at all. And I actually challenge that. As a passive investor and an active investor myself, I was spending about 750 hours or a little bit more every year to manage my active portfolio. And that allowed me to take advantage of the rep status, okay, real estate professional status. By the time I calculated all my cash flow, what I was earning about $450 per hour. Okay. Now that's not too shabby. Okay. Most people would take that. But when I started transitioning more into passive deals, especially into passive debt deals, I realized my time into the deal significantly reduced, and my dollar per hour that I was earning each year was skyrocketing. So I was about 12 to 36 hours total of managing my portfolio a year, and my dollar per hour was skyrocketing to 3,500 or more per hour um, on my return on time. Okay, so this again is another reason why I think even active investors should start taking chips off the table of their income that they're bringing in from their active rentals and start putting it into a passive deal, even like a passive debt deal. One, to build that liquidity, generate the cash flow. Okay, again, just smooth the ride and start kind of making that glide path into retirement. All right. So when do you start doing this? Okay. When do you actually start pulling the trigger on investing in your portfolio that's going to unlock those golden handcuffs for you? Well, the best time to do it was 10 years ago. The next best time is to do it today. Okay. Because we have to have consistent and persistent returns. Now, there is an error on this. This is actually not assuming 7% preferred return rather than our 8% on our debt fund, so ignore that. But again, you can see we're continuing to compound our return over time. And it's really the magic years, committing to this plan for 10 years. It's in year 6, 7, 8, and 9 that we actually start getting the hockey stick growth in that income that you can actually reliably count on to retire. All right, if you're here live, don't go anywhere. We're about to start the Ask Me Anything part of our show. If you are watching on your favorite podcast player of choice, make sure to join us at our Passive Investing Club, and you can join us there at passiveinvestingwithwhitney.com.